She's done a fantastic job. She and I work together, we think together, and in the past there have been examples, I won't give any specific, of chancellors and prime ministers who weren't sort of in lockstep. We're in lockstep.
Hello and welcome to the Week Ahead on Nomura Podcasts. I'm Dominic Bunning, Head of G10 FX Strategy for Nomura here in London, and today is 4th of July, or for our listeners in the US, Independence Day. We just heard there from the UK Prime Minister speaking on the BBC, offering his seemingly full support to Chancellor Rachel Reeves after a volatile few days for UK assets, as the government had to reverse course on a round of spending cuts that saw significant opposition from within their own party. The UK has seen another round of combined sterling and gilt weakness, a pattern which is becoming worryingly familiar from a UK perspective. Politics elsewhere, however, seems to be running a little bit more smoothly, with the US passing the budget bill through the House and the Senate and teeing up some degree of fiscal expansion for the year ahead. And this wasn't the only thing to celebrate in the US alongside Independence Day, with the US labour market also showing signs of positivity, although I will say the headlines on the jobs numbers probably mask some of the underlying weakness in the data, something we'll discuss later in the podcast. Tariffs still remain firmly on the agenda as we approach the 9th of July deadline imposed by President Trump. And with very few deals confirmed at this stage, the president stated that letters would be going out to various trade partners over the next few days, informing them of their tariff rates that they will face from the 1st of August. But for all of this noise, markets outside of a few idiosyncratic cases like the UK have generally been pretty sanguine, with most major bourses pushing higher, the dollar continuing its steady downtrend, which has been on the cards for the last few months, and bond yields also generally staying close to the bottom of their recent ranges. We'll be discussing all of this and more with a range of my colleagues and experts. So without any more waffle from me, let's get stuck in. Well, we have to start this week with the US as they celebrate Independence Day. We've got Ruchir Sharma joining us from our economics team in the aftermath of the US labour market report, which was actually released on Thursday this week. Ruchir, we've just seen what looks like a pretty solid labour market report, something else for you guys maybe to celebrate over the holiday weekend. How does this factor into your thinking about the economy and the Fed more broadly?
Hey, Dom. So not to sound like a party spoiler, but we think that despite the headline NFP beat, the broader contours of the June NFP report, they were in line with our expectations of a gradual slowdown in labor markets. The headline was actually bumped up by the government employment and specifically state and local education. Now, this component is pretty volatile around this time of the year since it's the end of the school year. So looking at the private sector jobs, we saw that the job gains actually slowed to 74K in the month. That's one of the slowest pace since October last year. It's definitely a relief and better than the ADP report, which had a negative trend, but we have consistently flagged that the ADP is not a good forecasting tool for monthly payrolls. So that said, we saw that cyclical sectors actually continued to slow, and it was only private education and leisure and hospitality which contributed to job gains. So this suggests that hiring is in fact slowing. As for the unemployment rate, it ticked down to 4.1% and was driven by a pickup in job finding, but broader household survey details were soft. So you had an increase in discouraged workers, the LFPR moved lower, and the household employment measure actually showed a growth of just 93K. So overall, the headline for today's reports should be healthy enough to keep the Fed patient about resuming rate cuts, but we think that the broader slowdown in labor market appears to be intact.
Okay, fair enough, but I guess it's still strong enough to make sure, or maybe not make sure, but suggest the Fed probably won't cut in July, and even September is still going to require some fairly soft inflation prints, I guess. But on that front, something that could drive inflation is obviously tariffs. And next week is a pretty big week in terms of the 9th of July tariff deadline kicking in again. It seems like there's been some progress, deals with Vietnam, possibly some others sort of being announced or semi-announced. Do you think we can expect more extensions, more deals, or do you think we're going back to those Liberation Day tariff rates for most trading partners next week?
Yeah, definitely. So uncertainty around trade policy persists as we approach the July 9 deadline for the 90-day tariff pause. So we saw last week how President Trump threatened to stall talks with Canada, and then Canada actually rescinded its digital service taxes with a view to progress towards a framework by July 21. But coming to the July 9 deadline, so far we have witnessed very few deals with a formal agreement signed with the UK. The US and China agreed to work towards normalizing trade relations, while we saw that this week President Trump posted details of a deal with Vietnam. So, again, we think that trade deals have been very slow, and despite numerous comments from the administration, a deal or essentially even a framework with India, South Korea, Japan that's yet to be finalized. So the Vietnam deal is an important thing, and we saw that the details were pretty hawkish. It included a 20% tariff and a punitive 40% tariffs on any transshipments. So the admin has reiterated that since April, that the first round of deals that countries would get, they're likely to offer some favorable or more amicable terms. And despite this being one of the first agreements, the tariff rate for Vietnam that was definitely higher than what we expected. So this suggests that other trading partners could face stricter measures and potentially be subjected to at least 10% tariffs, or if not higher. So, and again, there's another uncertainty about if the deadline is going to be extended, because last week we saw that Besant indicated that trade negotiations could extend beyond the deadline and potentially wrapping up by early September. However, this was somewhat contradicted by President Trump, who said he may not extend the deadline. So we do expect some additional trade agreements or announcements about potential frameworks next week. But we think that a complete reversion to the Liberation Day tariff levels is unlikely.
So the only certainty is a bit more uncertainty, maybe going into these into this week. We may get a bit more clarity just after recording this podcast on the other source of uncertainty, which is the budget sort of bill in the US, the big beautiful bill as it's been termed. It seems like it's gone through the Senate back to the House. Do you guys think this is going to have much impact on the economy at this point, or do you think, really it's just very small details which are being finalized at the moment?
Yeah, so as we speak, actually, the House is on track to pass the Senate's version of the One Big Beautiful Bill Act. And so one of the big things is that based on the CBO scoring, the bill is expected to add about $3.5 trillion to primary deficits over the next decade. And it was actually amusing how, despite certain reservations around deeper Medicaid cuts, accelerated phase outs of Biden-era energy tax credits, and the SALT thing, we saw that the House ratified the version. So talking about growth and inflation, we think that it's likely to offer a near-term front-loaded stimulus. But after the back and forth, it's likely to be concentrated on a couple of policies that actually Senate made permanent. So business tax provisions that Senate actually extended it through 2034. So they're going to impact and they're going to push up residential and non-residential equipment investment. So that's moderately positive for the GDP the next year. And in addition to that, you also have personal income tax provision, no tax on tips, overtime. So all of those things, they're going to bump up personal income and probably personal consumption. So it's more of a front-loaded stimulus cut, whereas the spending cuts are more backloaded. So we think on net, it's going to be neutral over the next decade, but definitely something that we're going to watch for a near-term growth impact.
Great. Thanks, Ruchir. Lots of clarity from you, even if not much clarity from the overall situation in the US. I appreciate your time as always, and enjoy your long weekend.
Thanks, Dom, for having me.
Now, moving on to Asia, we've got Jungwoo Park here, our Korea and Taiwan economist. Jungwoo, thanks for coming on the show. In the week ahead, we've got the Bank of Korea's policy decision. I think we've got a slightly out of consensus view around the Bank of Korea. So do you want to talk us through what you're thinking for this week, but also more broadly, why you have a slightly different view on the monetary policy outlook in Korea than maybe some other people do?
So next week, we will have the BOK meeting. And we think the BOK is likely to be hawkish. They are concerned about household debt. So they have shifted their policy stance toward the more hawkish side since we have seen housing prices rising, particularly in Seoul area. that's going to push up household debt. So the BOK thinks that the housing prices and the household debt, that's threatening their mandate of the financial stability. So obviously this time we are likely to see the BOK turning more hawkish. So in terms of the growth outlook, so although this meeting doesn't provide any update on the BOK economic outlook, but I think the BOK is likely to mention that the growth outlook is improving on a recovery in exports and the incoming second extra budget. So they will provide more upbeat economic outlook. And at the same time, the BOK, the forward guidance, usually, there are 6 members excluding governor. So previously, there were 4 members open to rates cut over the next 3 months, but this time, we think the only 1 or 2 members would be open to rates cut over the next 3 months, which is certainly is likely to look more hawkish. So overall, we think the BOK is likely to deliver hawkish hold this time. And the beyond July, so more broadly, I think the BOK is likely to leave the policy rate unchanged at 2.5% by end of this year, which is out of consensus call. As I mentioned, housing prices and the household debt are main concern for the BOK, and at the same time, the growth outlook is improving. So I think this time the BOK has some conditions to move, the resume rates again. The first one is obviously stability in the housing market, and secondly, the Fed cuts. And our house view is that the Fed is going to start rates cut only in December. So I think the BOK probably move after the Fed. So we think this year, for the rest of the year, we think the BOK is likely to remain on hold, and that the BOK will deliver final 25 basis point cut in February next year.
Thanks, Jimmy. Yeah, really interesting there in terms of a more hawkish outlook. How much of that hawkish outlook is also driven by maybe a benign view of US trade negotiations? We've seen some positive stories emerge with maybe the US and Vietnam and some other trading partners. Is this something with Korea that we're pretty relaxed about in terms of the impact of trade policy going forward? And I also note that, semiconductor prices have been ripping higher the last few months. I guess that's also a fairly positive thing for Korea.
Around Liberation Day, the BOK was really concerned about the tariff impact. But since then, we haven't seen easing tensions between the US and China particularly. So now is the BOK feel more relaxed about the tariff impact. More specifically, the US has maintained exemption on tech products, including chips. So, and the issues around auto vehicles and auto parts and the exemption on tech products, including chips. But in general, we think that the Korea can get a better deal with the US. So generally, the BOK, they seem to be more relaxing than 1 or 2 months ago compared.
Okay, brilliant. Thanks for your time, Jim. We really appreciate it, and we'll speak to you soon.
Thank you.
Well, moving on from Asia, we've just heard about the Bank of Korea's likely hawkishness, but we've also got rate decisions in Australia and New Zealand, where the hawkishness may be a little bit less forthcoming. Regular podcast host Andrew Ticehurst is with us for the 3rd week in a row, I think. Andrew, thanks very much for coming on. Let's start with a simple question. What do you think is going to happen this week with both the RBA and the RBNZ?
Yeah, hey Dom, my pleasure, thanks. Look, we've got 2 central banks down here and we're forecasting 2 rate cuts. RBNZ is the closer call and the more controversial. So yeah, maybe just starting there. We think they will deliver an 8th consecutive rate cut. The market hasn't got it priced. But we think the growth outlook there is softened up a little bit lately, and we can't see too many problems on the inflation front. And we think the RBNZ might like to deliver just one more that would get the cash rate down to 3%, and then maybe move to the sidelines. 3% is a nice round number, and their estimate of neutral. So I think that might be a good place to pause. Just quickly on the RBA, different story, of course. They have delivered a lot less easing in the cycle to date. So we think they've got more to go. Pretty confident they're going to deliver us a 25 basis point rate cut. Inflation's very much around target. The latest news on inflation has been good, and policy still quite north of their neutral estimate.
Okay, Andrew, so 2 cuts this week, but it sounds like there's a bit of potential divergence coming thereafter. How do you see things kind of playing out in Australia and New Zealand maybe over the next few months?
Yeah, look, I'd say both countries are growing, but at sub-trend sort of pace. The RBNZ has delivered a lot more easing to date, so we think they're closer to being done. RBA has been a lot more cautious in its easing, and I guess that goes back to the fact that it didn't hike so much, but it's gradually coming to the party now. They've delivered 2 rate cuts, the RBA. We've got a third coming in July, and then 2 more, August and November. That would also take their cash rate down to just above 3%, 3.1%, and we think that's pretty close to neutral. But for the RBNZ, they've done most of the work, so we think it could be pretty much one and done from them.
Oh, thanks, Angie, for joining us there. Very interesting. A bit of divergence potentially coming between the RBA and RBNZ, something to watch going forward. Thanks a lot. Well, we'll finish where we started in the UK and Europe. We've got Josie Anderson from our economics team joining us. Josie, thanks a lot for coming on the podcast. Look, we've got to start this section with the UK and the political and fiscal issues which have been raised this week. The government failed again to pass a reform which would have curbed spending, this time on welfare payments, probably costing around £5 billion or so. Just how precarious are the UK's public finances? And do you think this is going to have much impact on growth in the months ahead?
Yeah, thanks, Tom. So, the government's inability to lower spending by even a relatively small amount, this $5 billion, illustrates the challenges that it really faces and how precarious, the financial position is for public finances. So we had the total U-turn, the capitulation ahead of the welfare bill finally passing on Wednesday evening this week. And then the following day, we even had gilt market stress in reaction to the Prime Minister not fully implying his confidence in Rachel Reeves, but then he did come out and say that we work together, we think together this morning as we record it together today on Thursday. But I think the fact that financial markets have had such a reaction really highlights the concern that the government might not be able to keep to its fiscal rules and how important it is that it does keep to them. And that's because the buffer is so small, just 9.9 billion that the OBR calculated in March, and that headroom could easily be used up even just through the OBR changing its GDP growth forecasts or changes in the bond market. And so it's a really tricky position for the Chancellor.
Yeah, we've certainly seen that on our side from the FX perspective where, sterling does seem to have this quite nasty asymmetry to both sides of the growth story. If growth weakens, sterling can fall, but if you get these stronger yields or concerns about fiscal sustainability, then the pound comes under pressure as well. So, lots of challenges in the UK. Another challenge for the region is probably going to be more to do with Europe as a whole and the 9th of July tariff deadline that's approaching. Are we seeing any signs of progress in terms of a trade deal between Europe and the US, or the European Union and the US, I should say? Can we get a delay? Is it going to be a left-hand tail risk for the European economy?
Yeah, so the position we're currently in is that on next Thursday, the original reciprocal tariff rate that we would be receiving for the EU was 20%, but then Trump has subsequently threatened 50% tariffs and doubling on Spain if NATO commitments are not observed next week. I think that's very unlikely to occur, but it's still all to play for. And talks are ongoing with EU representatives in the US this week. von der Leyen said that they are aiming for a trade agreement in principle with the US, so it will take a long time to come to a full agreement. A Bloomberg report earlier this week also said that the EU would be willing to accept a trade deal that includes a 10% universal tariff on many of its export, but it really wants to get a commitment from the US that they won't see those higher rates, or indeed they want lower rates on key sectors such as pharmaceuticals. But the EU has been playing hardball, which has been frustrating Trump, and they've also definitely been preparing retaliation measures in case they don't get a deal that they're satisfied with. So we'll see lots of headlines on that, certainly, perhaps even before this comes out.
Yeah, I mean, it definitely seems like the market's become a little bit more sanguine on these risks. And, I think certainly in terms of the euro, for example, the strong performance of the currency has all been tied up in that. But it's also having possibly some dampening impacts on European inflation, which a number of ECB members have been speaking about this week. So I don't think it's quite as, easy as many people seem to be thinking, that the trade deals are going to go through and everything's going to be hunky-dory. There's definitely still some risks out there for Europe. Speaking about inflation there in Europe, I mean, this week, really the main data is probably in Scandinavia, where we have inflation prints both in Norway and Sweden. And we've also seen a bit more of a dovish bias from both of those central banks in the last month or so. Do we think inflation is going to stay pretty soft this month?
Yeah, it's interesting because we saw cuts from the Riksbank and Norges Bank last month on the back of a view that inflation is going to slow over the course of the coming months, but more in the medium term than in the immediate term, because actually we and those central banks are forecasting an acceleration in inflation in both Sweden and Norway, albeit small accelerations in June, which is the data we get next week. And so they're looking through above target inflation in both those countries. And are expecting it to come down towards the end of the year. And so, yes, we're expecting 2.4% CPIF inflation in Sweden. That's the measure that they target, and 3.2% CPI inflation in Norway. And that's roughly in line with the Norges Bank's forecast. And they made that forecast at the same time as cutting their policy rate by 25 basis points. And it just goes to show that they think their policy rate at now 4.25% is still quite restrictive, so still placing downwards pressure on inflation even after that cut.
Interesting how there's this sort of slight upward tick at the moment, but the overall pressure is probably still to the downside. So there's something I think for a lot of people to think about across Europe in terms of inflation dynamics as we go through the summer and then into probably Q4, where maybe inflation pressures could start to soften again. Thanks very much, Josie. Great to have you on the show as always, and we look forward to speaking to you soon.
Thanks, Dom.
Well, that seems a good place to end it for this week. Thank you for listening in to this week's edition of The Week Ahead, which was edited and produced, as always, by John Dalton. If you're enjoying the show, please like and subscribe to Nomura's podcast on Apple, Spotify, SoundCloud, or wherever it is you get your weekly podcast fix. We'd love to hear your feedback, so please do write a review and share this podcast with your friends, family, colleagues, and anyone else you think might be interested.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision, and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice, nor is legal, regulatory, accounting, or tax advice, and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.